All righty. So you stated that you're concerned about, of all the debts you've got, you're concerned most about the HELOC and then the car, right? Your Chase car and this city card. The other ones you just kind of pay off and no big deal. So what I've done is I'd like to focus on those. First of all, let's note this. Your HELOC, your interest rate, 6.2%. And your payment is $1,100, or I think it was 1,095 is what you told me, but 1,100 about that. And then let's look at the amortization chart. And what this says is that right now, your principal payment of the $1,100, 645 of that is going toward interest, and only 454 of that is going toward principal. Okay, so how does this play out? Well, I put this into a spreadsheet. Oh, let's just look at the other ones also then. So the car, you owe 49,000 on the car. The interest rate's 5.5, and if you look at the amortization chart right now, you are making a payment of 767. Of that, 226 of that is going toward interest. 540 of that is going toward principal. And if we look at the city card, which is also the one that you wanted to wipe out, that city card right now is at 18%. But if you look at the effective interest rate, it's really 59.73%. So what does that mean? Of every payment of $226, you've got 135 of that going toward interest and only 91 of it going toward principal. So I broke this into a spreadsheet so that might help you see it a little bit better. So here we go. 6.2% is the cost. This is your HELOC. So your HELOC is $125,000 and you're paying 6.2% APR, which means you have a monthly payment of $1,095. Again, I know it showed on the other 1,100, but there we go. And of that, like we just said, in your first month, right now, of that 1,095, 646 of that is going toward interest, and 450 of it is going toward principal, which means that currently right now the volume of interest you're paying is 59%. So of every 1,000, 590 of that is going toward interest. This is your volume of interest right now. Now what this one means, your cumulative interest paid, is if you pay this over a 14.4, that's how many more years you got to pay on this thing, 14.4 years more. If you pay it off over that amount of time, the cumulative interest that you've paid on this note will be 51.4%. And I know you're thinking, but wait a minute, this is a note at 6.2. Yeah, it is. That's the APR. But your cumulative interest paid, it's as if you made a payment of $514 of every $1,000 you put against this loan is going toward interest over the entire life of this loan. Because you'll notice that it's at 59, at 5 years it's at 44, at 10 years it's at 24, and it doesn't finally get down below 6.2 until you're in the very last year. Okay, now, if we go and use the private equity banking method, you'll note that I moved the interest rate to 0.1. Now, that's because the policy that I have currently proposed to you, it's inverted. Currently, they're paying 5.2% on everything that you're earning, and when you borrow, you're borrowing at 5, so you've got a positive arbitrage of 20 basis points, or 0.2%, right? But I just made this 0.1 just so that my system would work because I couldn't put in 0. But basically figure you're just paying down the principal on that loan. That's all. So here's what happens. I kept the time at 14.4 years, same as before. And you'll notice that your payment drops from $1,100 to $729. Of that, right, of that 729, 718 of that is going toward principal, and only $10 of it is going toward interest. This is what you folks can do when you get a private equity bank note. Now, the reason I showed the difference in payment over the same amount of time is because you guys are strapped right now. That's what you've told me. You're strapped. You're not. Your expenses are exceeding your income, and so lowering the amount of the payment would be a good thing. Another thing you could do, if that wasn't an issue, you'll have another option with the private equity banking is to shrink the time. So here we keep the payment at $1,095, but you'll note that we've shrunk it from 14 and a half years down to 9.5 years. So down to nine and a half years. You'd have this note paid off if you continue to pay at $1,095. Okay? So, and again, the interest rate, you're only paying $10 toward it. Let's look at the car and do the same thing. Currently, your car loan is at 5.5. The total note is at 49,624. Currently, you're making payments of 763. Of that, 536 is going toward principal. 227 is going toward interest. You have a volume of interest of 29.8 and a cumulative interest. So for every $1,000 you pay over the life of this thing, it's going to average out at about $190 of every $1,000 you pay is going to go toward interest. Okay, and you'll have this paid off in 6.5 years. If you want to reduce the payment and keep the years the same, you're still at 6.5 years, but now your payment is 643, right? Principal of that is 639, and interest, you're paying $4 whole on that interest rate. And so over time, your interest, your cumulative interest, if you pay it off over the 6.5 years, is 0.3%. All right, 0.3, not 3, 0.3. Okay, now obviously you can keep the time the same, where we still keep it at 5.5 years, and now you're paying. Sorry, this time we're changing the time, so now it's down to 5.5 years instead of 6.5. Still making the same payment. You pay that off in the same amount of time. Or no, in 5.4 years instead of the 6.5. So you pay it off a year quicker. And again, every payment that you make at 763, 759 of that is going toward principal. 4 of it is going toward interest. Let's look at the Visa. Here's your Visa. You owe $9,000 on it. It's at 18%. Currently, it will take you 5.2 years to pay that off, making the payments that they're requesting of 223. Of that 223 payment, 88 is all that's going toward principal. The rest of it, 135, is going toward interest. So your volume of interest right now, for every $1,000 you pay toward this credit card right now, 605 of that is going into interest. Okay, cumulatively over the life of this thing, every $1,000 you pay against that credit card, 547 of it is going toward interest. Okay, so we can lower the payment, take it down to 145. Again, at that point, 144 of it is going toward principal and $1 is going toward interest. Or we can shrink the time down to 3.38 years, continue paying 223, at which point 222 of it is going toward principal and $1 is going toward interest. This is the power of private equity banking, what it allows you to do. And so let's look at the overview here. I've put them all in here. Again, I know you've got other loans. You'd like to pay off the house or whatever. But right now, this is what you guys were saying was your focus. So you've got $125,000 on the HELOC, and your payment on that is $1,095. Or you can shrink that payment down to $729 and continue to pay this off in 14.4 years. Or you can continue to pay the $1,095 and pay it off in 9.56 years. Again, your APR is 6.2 with the loan using arbitrage. I put it at 0.1. It would really be zeros because all you'd have to do is pay back the principal because you're making money with that policy. Your volume of interest at 1 is 1.4% instead of 558.96. Okay, so what does that mean? That means of every payment of $1,095, 645 of that is going toward interest. Whereas if you're using a private equity banking loan, now you're paying $10.42 toward interest, whether you shrink the time or you keep the payment. So whether you're paying $729 on this payment or you're still paying the $1,095, interest is only $10.42. So if you want to stretch that out to make those payments smaller to help your current budget, that's what I would do. Okay, your cumulative average interest paid over the life of this HELOC would be $563 for every 1,000, and here you've got 5.29, $5.29. Again, $5.29. Either way you do it, total interest paid if you're doing it by reducing the payment down to $729, now over the life of that loan, you will pay $907 in interest instead of $64,000. And if you decide to keep paying the $1,095 and pay it off in 9 years and a half, 9.5 years, now the total interest you pay on that whole thing for 9.5 years is $604. Think about that, folks. $604 to be able to borrow $125 over 9.5 years. Okay, same thing with the car, 49,000. Again, you can keep the payments the same and pay the insurance, pay your Chase auto loan, 9,433 over the life of that loan, which is 6.4 years. Or you can drop the payment down to 643 and still pay it off. Now total cumulative interest paid is $4.14, or a total amount of payment for each payment, it's $4.14 is what's going toward interest of each payment, and a total interest paid over the life of that loan of $162. Or you can keep paying the $763, pay it off in 5.5 years, and only pay $137 in interest over the life of that loan. If we're looking at the Visa card, same kind of idea. You owe $9,000. If you make the regular payments right now, your cost is going to be $4,921 of interest, versus if you drop the payment down to $145 and pay it off over the same amount of time, you've paid 24 whole dollars in interest over the 5.2 years, or you can continue to make the $223 payment, pay it off in 3.3 years, and have only paid $16. So I know you guys say you're stressed with how much money you're paying. So you can choose to do nothing. If you do nothing, you don't use private equity banking, you are going to spend $78,647 on those 3 loans. Or you could put that money into a private equity banking account, borrow it back, and you would end up paying $1,093 on those loans. Total interest saved, $77,000. Or if you wanted to pay it over time quicker, again, $78,647 is what you would normally pay. Doing it this way, if you paid it off quicker, it would be $756 in total interest, saving you $77,891. Okay, so we've seen all this, and all this does is show the savings side of it. But now let's show what happens with your money still growing. So what I had to do here is I put 183, which would be the car, the HELOC, and that Chase in, and I put it at 6.2. I know those other notes are just a little bit higher than that. Well, one's a little lower, one's a little higher, but this is the longest one. So I hope you're okay with me just putting in the 6.2 to make the point, okay? So over the next 173 months, so 14.4 years, you're going to end up paying the first year $11,000 in interest, the next year $21,000 in interest, the next year $31,000, $42,000, cumulatively $50,000, as we see, and finally down here at the end, $94,000 will be paid in interest if this is all you do over that 14, if you paid it over that time. Now, I'm very well aware of the fact you guys are going to have the option to just pay cash, and that's what I want to show you here. So if you pay cash, let's say when that money comes in, you were to pay the 184 and pay those 3 notes off. The question then becomes, well, how much does that money earn over the next 15 years? The answer is none. So then we look at it as though it's a private equity banking account. So here, as you see, currently the policy that I can get you into is making 5.2%, and it's to borrow against it, it's charging 5. Okay, so your 184,000 would grow to become 193,000 in the first year. In other words, it grows by $9,799. The next year, it's going to grow to 204. So it would be a cumulative earned of 20,000. After 5 years, that 184 has grown to 238, and the cumulative growth is now $54,000. After 10 years, that 184 has grown to 309,000, and it's made 125,000. And in the 14th year, it has grown to $380,000, and it has grown by $196,000. So the money has doubled itself in that amount of time. That said, but you also had to borrow money against the policy. So you'd still be making those payments to pay that down, but now you're just basically paying principal. So the interest that you'd end up paying the insurance company the first year would be 8,997, the next year 17, the next year 25, cumulative 33, etc. And so over that same period of time of 14.4 years, you would have spent $74,000 on interest instead of versus the 196 that you made. So if we look at the total of where you're at, so after the end of 14 months, you would have a cash value of 388,000, right? And your interest earned at that point would be 204, but you'd have to pay 74,000 in interest. You have a positive arbitrage there of $130,000, right? So the total cost of all those together really only cost you 53 when you look at it that way, because you made 130. Or what you can look at it as, which would be just as valid, is in 15 years, you've got 400,000 sitting in the bank. Your money has grown by 216,000. Over here, if you pay this off, all you do is get to zero. Your bank account has nothing in it. Now your bank account has 400,000 in it, and it's grown by 216. Now you guys are 45, so if we just add 15 years there, right, that takes us to 60. You think you're going to make it to 60? Probably. Well, what happens if you make it to 70? Another 10 years after that, right? Now that money is worth $639,000. Is that 70? No, 70 would be right here. Okay. Now that money's worth 673,000, and it's grown. That 184 has grown to become 489,000. That's where you begin to start your retirement. That's where you can pull your retirement money out and borrow against this. That's what makes this so much more powerful. The alternative you have is paying it in cash when you get that money, or building a private equity banking